You hear the same financial advice everywhere you go. Track your spending, cut out the extra coffee, skip the restaurant. It makes sense on paper, of course. You definitely want to keep your expenses reasonable. But trying to budget your way to real wealth usually leaves people feeling stuck and frustrated. There's a hard limit to how much you can cut, but there's no limit to how much you can earn. Focusing on your income actually moves the needle. If you spend hours stressing over how to save $20 a month, you just drain your energy. That exact same energy could go toward making an extra $200 a month instead. People often feel intensely guilty about buying a simple latte because they think it ruins their future. It doesn't. The real issue is staying at an income level that makes a coffee feel like a serious threat. What's actually happening here? You're trading your mental peace for tiny savings. Why does it matter? Because those tiny savings will never compound into the freedom you actually want. Think about the last time you felt guilty at a checkout counter. That guilt doesn't build wealth. It just builds stress. When you shift your focus from shrinking your life to growing your income, the whole game changes. You stop playing defense and start playing offense. So how do you actually make that jump and start earning more? It usually comes down to leveling up your knowledge and your skills. A lot of people think they just need to work harder or put in more hours at their current job. But working more hours at the same rate won't change your life. You need to increase your value in the market. You could read a book that sharpens your industry skills. You could take a weekend course. You might even get a new certification that opens up a higher pay bracket. Let's say you work in marketing, or maybe you run your own small business. Reading something like Purple Cow by Seth Godin can completely reshape how you look at your daily tasks. You suddenly find a new way to bring real value to your clients. One small lesson from a single book can be the exact push you need to negotiate an extra $500 a month. What does this mean for your life? It means your earning potential is entirely in your own hands. You don't have to wait for someone to hand you a raise out of nowhere. You can go out, learn a new way to solve a problem, and charge for it. When you build skills, nobody can ever take that value away from you. People often chase a massive salary because they think it'll finally make them happy. You probably hear people say that once they hit $200,000 or $300,000 a year, they'll finally feel secure. We all build up these random giant numbers in our heads. We tell ourselves that crossing that specific finish line will magically fix everything, but those huge numbers are rarely based on anything real. They're just guesses. And working yourself to the bone for a guess is a terrible way to live. A lot of us are terrified of falling behind, so we just aim for the highest number possible. The truth is, you probably need a lot less money than you think to live a really great life. What happens when you don't know your real number? You end up running on a treadmill that never stops. You keep chasing more without ever knowing why. Why does this matter? Because once you strip away the social pressure and look at what you actually want, the math changes. You stop working for a status symbol and start working for your own life. You might find out that your perfect lifestyle costs half of what you assumed. You can figure out your real number by working backward. Sit down and write out exactly what your dream life costs every single month. Don't guess. Actually list the numbers. Let's say you want to spend $1,000 a month eating at nice restaurants. You want $300 for clothes, $300 for hobbies, and $500 for dates. You even throw in $100 just to buy expensive coffee 4 times a week. Your rent comes to $2,700 and you drive a nice car that costs $1,000 a month. You aren't flying private, but you're living extremely well. All of that spending adds up to $5,900 a month. Add another $1,100 for savings, and you hit $7,000 a month. With a 33% tax rate, you need to earn about $125,000 a year to live this dream life. That's still a great income, but it's nowhere near that scary $300,000 target. Why is this exercise so powerful? Because it turns a vague fear of not having enough into a simple math problem. You give yourself a clear, realistic target. When you do this math for your own life, you usually feel a massive weight lift off your shoulders. You realize you don't need to work yourself into the ground to be happy. You'll eventually reach a point where buying stuff just stops feeling special. A lot of people fall into the habit of rewarding themselves with physical things. You buy a fancy winter coat, a sharp new watch, or maybe even expensive collectibles like rare trading cards. While those things are fun for a little while, the excitement fades really fast. You buy them hoping they'll make you feel successful, but they just end up sitting on a shelf. The moments that actually bring real warmth to your life are the experiences you share with people you care about. We often stress over spending money on a trip because we have nothing physical to show for it afterward, but that's exactly why it matters so much. What happens when you shift your money toward experiences? You stop collecting clutter and start collecting stories. Why does this matter long term? Because a nice jacket will end up in a donation bin in 5 years, but a great memory stays with you forever. Connecting this to your everyday life changes how you view your bank account. You stop seeing your money as a way to buy status. You start seeing it as a tool to buy time with your favorite people. Let's look at a real example of how this plays out. You could spend $3,000 today on an expensive desk chair or a designer wallet. Or you could spend that exact same $3,000 to fly to Chicago, stay for 4 days, and run a marathon with your friend Mark. When you hit 75 or 85 years old, you won't spend a single second thinking about that wallet you bought in your 30s. You probably won't even remember what color it was. But you'll absolutely remember the feeling of crossing that finish line in Chicago with Mark. You'll cherish the memory of sharing a deep dish pizza right after the race. Some people genuinely get joy from material things, and that's completely fine. But most people want to build wealth so they can actually experience more of the world. Why does making this choice matter today? Because time moves fast and your window to travel and take on physical challenges won't stay open forever. By choosing the trip over the object, you guarantee a return on your investment through memories. You build a life that feels full on the inside instead of a life that just looks rich on the outside. Traveling creates memories, but it also brings a lot of unexpected stress. A simple rule can save your entire vacation. Always add 10% more to your travel budget than you think you'll actually need. People build a perfect spreadsheet for their trip down to the last dollar, but a spreadsheet can't predict the real world. Something inconvenient will happen. You might miss a connecting flight. Your hotel might lose your booking. You might even get scammed by a street vendor in Paris who sells you fake tickets to the Eiffel Tower. When you don't plan for chaos, every single surprise feels like a personal attack. You feel angry because your tight budget just broke. What's happening beneath the surface here? You're letting a small money problem ruin an expensive trip. Why does this matter? Because travel is supposed to be your escape, not a new source of financial panic. Giving yourself a 10% buffer changes how you react to bad luck. Instead of feeling cheated or stressed, you just dip into your emergency fund and move on. You buy your peace of mind before the plane even leaves the runway. That extra 10% budget buffer becomes even more crucial when you travel with other people. Group trips bring out a lot of tension about money. Everyone has a slightly different idea of what things should cost. If the group suddenly has to spend an extra $200 on a taxi because the train shut down, the mood can completely crash. People get resentful. They get quiet. A sudden expense can create real friction between couples or friends, and that bitter feeling can sour the rest of the day. Why do we react this way? Because unexpected costs make us feel out of control. We hate feeling like we're bleeding cash. How does this connect to your real life? You work hard all year to take a break. Letting a minor $200 problem ruin a $4,000 trip is terrible math. When you accept up front that things will go wrong and you set aside the cash to handle it, you protect your relationships, you protect the vibe of the trip. You basically tell yourself that chaos is just part of the ticket price. Budgeting a little more keeps everyone relaxed, and you'll absolutely thank yourself later. Taking on debt to buy something that drops in value is a fast way to destroy your net worth. The most common trap is buying a brand new car, but today the problem is everywhere. You can get a loan for almost anything now. You can use buy now, pay later programs to finance your takeout food, new clothes, or a fancy vacation. People use these programs because the small monthly payments make expensive things feel affordable, but you're buying items that lose value the exact second you receive them. When you take out a loan for a depreciating asset, you're taking a double hit. You pay interest on the loan, and the item itself drops in price. Take a $50,000 car as an example. You sign the papers, and your net worth stays the same on day one. But after just 12 months, the car loses 20% of its value. It's now only worth $40,000. Your net worth just dropped by $10,000. You also paid $2,000 in interest to the bank that year. What does this actually mean? You just paid $12,000 in 1 year for zero benefit. You're literally paying your own money just to lose money. It's a cycle that keeps people completely stuck. There's a real-world exception to this rule because life doesn't always fit perfectly into a spreadsheet. Sometimes you simply need a car loan to get to work. Imagine you only have enough cash to buy a $3,000 car, but that cheap car keeps breaking down and you constantly spend money on heavy repairs. It causes you massive stress and makes you late for your job. In that exact situation, it actually makes sense to use that $3,000 as a down payment on a solid, reliable used car. With a fair interest rate, yes, you're taking on debt, but you're protecting your income by making sure you can actually arrive at work every day. A lot of people try to justify bad loans by saying that as long as they can afford the monthly payment, they can buy whatever they want. While the math might technically work out, buying things that rapidly lose value will hold you back. If your actual goal is to escape that cycle and master how to keep the money you earn, sticking around for our weekly videos helps you spot these specific traps before they catch you. Avoiding rapid depreciation completely changes the timeline of your financial freedom. The tax filing deadline offers a strange hidden advantage that catches a lot of people off guard. Most people assume the clock stops ticking on New Year's Eve for their retirement accounts. You might feel a sting of panic in December if you realize you haven't hit your savings target for the year. Life happens. Your car breaks down, or maybe rent went up, and you just couldn't put the cash away. But the IRS actually gives you until mid-April to keep building up your Roth IRA for the previous year. This built-in buffer completely changes how you can handle year-end cash crunches. You get an extra 3.5 months to catch your breath and find the money. Why does this tiny calendar quirk matter so much? Because it takes the pressure off the holiday season. You don't have to choose between buying gifts for your family and funding your future. You can enjoy December, map out a plan in January, and still max out your contributions before tax day. It turns a stressful deadline into a flexible window of opportunity. It gives you space to be human with your money. Let's look at how this calendar trick actually plays out in real life. In 2025, anyone under 50 can put up to $7,000 into a Roth IRA. If you are over 50, that limit jumps to $8,000 to help you catch up. Imagine it is already April 14th, 2026. You completely forgot to save anything for your retirement during the entire 2025 calendar year. The beauty of this rule is that you can log into your account, deposit that $7,000, and fully cover your 2025 limit right then and there. Then, you still have the entire rest of 2026 to work on that year's savings goal. What does this actually mean for your daily life? It means a slow year doesn't have to permanently derail your long-term plans. You can use a spring bonus or a tax refund to backfill the gap. A lot of people walk away from their tax returns feeling totally drained. Knowing you have this safety valve helps you claw back some control. You stop feeling like you are always running late. You finally get to play the game on your own timeline. Numbers on a spreadsheet only tell half the story when you deal with debt. We constantly hear that investing extra cash beats paying off a low-interest loan. You might have a friend holding a $28,000 car loan with a 7% interest rate. Every financial calculator will tell them to keep the loan and put their spare cash in the market instead. The market might average an 8% return. Mathematically, investing that cash nets a 1% profit over paying off the car. That 1% difference looks like a clear victory on a computer screen. But what a spreadsheet cannot measure is the heavy feeling in your chest every time that monthly payment hits. You wake up thinking about what you owe. You hate knowing the bank essentially owns your car. How do you put a price tag on that low-level, constant anxiety? A lot of people feel paralyzed because the smart math completely ignores their actual feelings. You aren't a robot optimizing code. You live a real life where stress drains your energy. Sometimes, making the mathematically inferior choice is the exact move that lets you sleep at night. You can actually weigh that emotional burden against the raw math to make a clear choice. Take that same $28,000 car loan. That 1% difference between the loan rate and expected market returns equals roughly $280 a year. You have to ask yourself a hard question. Is the mental weight of carrying that loan worth $280 to you? For most people, $280 is a remarkably cheap price to pay to completely eliminate a source of daily stress. You also have to factor in market volatility. The market doesn't smoothly deliver an 8% return every year. Some years it drops. If you easily panic when your portfolio goes red, keeping the loan while investing just adds a second layer of anxiety. You worry about the car payment and you worry about your stocks crashing at the same time. Why does this balance matter? Because wealth is supposed to buy you freedom, not trap you in a cycle of worry. If paying off the car frees your mind to focus on your career, your family, or just relaxing on a Sunday, that peace is worth way more than a tiny percentage point. Debt often acts like a silent anchor, dragging behind your biggest life choices. People routinely turn down new opportunities simply because they feel chained to a monthly payment. You might get a chance to take a fascinating new job that pays slightly less at first, but offers massive growth. Or you might want to move to a new city to start fresh, but you look at that car loan and you freeze. You decide to play it safe. You stay in a job you hate just to keep the payments flowing. The real cost of that debt isn't the interest rate at all. The real cost is the life you didn't get to live because you were too scared to take a risk. How much is that lost opportunity worth? Probably thousands of dollars, maybe even more. When you strip away the math and look at how debt shapes your behavior, paying it off quickly becomes a strategy for unlocking your future. It gives you the power to say yes to things that actually matter. You stop making decisions based on fear and start making them based on what you actually want out of life. Watching a stock completely crash and burn is a sickening feeling that almost everyone experiences eventually. You do your homework, you buy in, and suddenly a single bad quarter wipes out $50,000 of your money. It feels like a massive punch to the gut. You might even want to delete your brokerage app and never look at it again. But the tax code actually offers a strange safety net for these exact disasters. The IRS lets you use those painful losses to cancel out taxes on your future wins. This is a massive hidden advantage that stops a bad year from ruining your whole decade. Say you lose that $50,000 in year one, but in the exact same year, you sell a different stock and make $20,000 in pure profit. You can match the $20,000 win against the $50,000 loss. Suddenly, you owe zero taxes on that gain. You just protected thousands of dollars from the government. Why does knowing this change your mindset? It takes the sting out of a losing bet. You realize a loss isn't a permanent failure. It just becomes a shield you can use to protect your money later. That tax shield doesn't just vanish at the end of the year either. The really powerful part is that your leftover losses carry forward into the future. After matching that $20,000 gain, you still have $30,000 of your original loss left over. When year two rolls around, maybe you sell another old investment and clear a $15,000 profit. You just reach into that leftover bucket of losses, apply $15,000 of it, and again, you pay zero taxes on the new gain. You can keep doing this year after year until the entire original loss is completely used up. What is really happening here? You are essentially turning a terrible mistake into a tax-free pass for your future successes. A lot of new investors panic and hold on to crashing stocks forever because they refuse to accept the loss. They trap their money in a dead idea. Understanding this carry forward rule gives you permission to finally let go. You can sell the bad stock, capture the tax benefit, and put whatever money is left into something that actually has a chance to grow. There is another layer to this rule that directly helps your everyday paycheck. After you match your losses against your investment gains, you can actually take $3,000 of any leftover loss and subtract it from your regular job income. That lowers the total amount of money you owe income taxes on for that year. It literally reduces the tax burden on the salary you work so hard for every week. The order of how you do this matters. You always offset your investment gains first. If you still have losses left in the bucket after that, then you take the $3,000 deduction against your salary. Whatever is left over simply moves to the next year to start the cycle again. Why is this detail so comforting? Because it means even if the market is totally flat and you don't sell any winners, you still get a tangible benefit right now. Your bad investment choice ends up slightly shrinking your tax bill at your normal job. Losing money still hurts. Nobody wants to lose 50 grand. But knowing the system is designed to help you recover faster makes it a lot easier to stay in the game. Everyone eventually meets someone who seems to have a magical touch with the stock market. A friend tells you about a company, you buy a few shares, and the price shoots up. You check their other ideas, and those are all climbing too. It feels like you just found a secret cheat code. You start believing this person is an absolute genius who can see the future. So the next time they mention a new opportunity, you throw your money at it without a second thought. And that is exactly when you lose your shirt. What goes wrong here? A couple of lucky guesses during a booming market can make anyone look brilliant. A rising tide lifts all boats, as the old saying goes. Your friend might have genuinely understood one specific industry really well, but when they try to pick a winner in a totally different sector, they are just throwing darts blindfolded. Following someone else's hot tip is a massive trap because you are skipping the actual work. When the stock drops, you have no idea why it fell or if you should hold on. You outsourced your thinking, and now you have to pay the price. Blindly trusting someone else's winning streak is a dangerous way to handle the money you worked so hard to save. The financial world slaps warnings on everything, saying that past results never guarantee what happens next. They do that for a very good reason. Markets shift entirely. What worked brilliantly 6 months ago might be a complete disaster today. You always have to look at every single new idea with fresh eyes, even if the tip comes from your smartest friend. You need to understand exactly what you are buying and why it makes sense for your own specific goals. Taking ownership of your choices builds real confidence. You stop reacting to rumors and start building a strategy you actually believe in. When you do your own digging, you sleep better at night, regardless of what the market does. Understanding the why behind your money is the only real way to build lasting wealth. If you want to keep sharpening your own instincts and learning how to trust your own decisions, subscribing to Kyle Invests keeps those practical insights coming every single day.